It does.
Yeah. So, good afternoon, everyone, and a warm welcome. Uh, Welcome to the Q3 and 9-month FY22 earnings call of 3iinfotech. On the panel, we have Mr. Thompson Gnanam, MD and Global CEO, Mr. Harish Shenoy, Interim Global CFO, and Mr. Sanjay Rawa, India CFO and Finance Controller. With that, I hand it over to Mr. Thompson Gnanam for his opening remarks. Post that, we will have a Q&A session. I will guide you through the Q&A session once Thompson sir completes his opening remarks. Over to you, Thompson sir.
Thank you, Snyder. So good afternoon, everybody, and good afternoon, and it's thanks a lot for being part of this earnings call, and thanks for your support and trust on the brand as we transform this 3i into the new 3i in this journey which we have now started in the last 9 months. So I will just quickly take you all through a few slides, and then maybe we can open up for conversation. So Snyder, if you can move on the slides, please. Yeah. So I'm just going to maybe skip these slides, Snyder. Let's move on. Our vision, mission, and this is a quick snapshot on where we are as an organization. As we speak, we are closing on to almost 5,000 people. We will exit this year, and we'll just move on to the next slide, Snyder. A quick refresh for all our investors and shareholders in terms of the services we offer, right from application development, testing, infrastructure services, cloud first, and also a lot of next generation services we are building, and these capabilities. We'll talk more about them in the coming slides. Anyone more? Yeah. A quick refresh on this slide for all our benefit, because now we are slowly moving as this is the third quarter of this new organization and the new management team. Most of these strategies are now starting to get implemented. I want to kind of dwell upon Q3 especially has been a critical quarter for us, because as we are running our businesses, we are also investing in our grow and build strategies, which is extremely critical for our organization. I'll spend a minute on this slide for benefit of everybody. So the run organization or the run strategy is something which 3iinfotech post carve out effective 1st April is what we call as the run organization. It is the services business which we inherited as an organization post the carve out of the product division, and the service lines we are servicing and the customers. That's a run organization, and our focus on the run organization is to fortify the run, drive improvements in terms of margin enhancements, try and see how we can kind of enhance our profitability, because today the run P&L literally funds the remaining part of the organization in terms of grow and build. I'll touch upon it also as we kind of delve deeper into the Q3 results as well. The grow organization is the engine of growth for this company, and where we are building the new service lines, building our next generation consultative transformation-led sales organizations, which is predominantly consulting-led, transformation-led, where we kind of want to work with our customers in solving their problems and being an end-to-end integrator and an orchestrator. So that is where we are now investing, and this is going to kind of help us drive the growth in our coming years. Second, the second thing is also in terms of the ability to change the revenue mix from the run to grow. If you look at it, we will talk about it in the numbers, but the run gross margins are less for us as an organization. It's very important we change the mix of revenue, and grow is going to drive that. The build focus is fundamentally because if you look at it, we came out of a CDR in March 31st. We sold our product division. So it's all the family jewels and the crown jewels are sold. But the good thing is we have a better balance sheet. We are debt free. But now we need to rebuild some of these, value enabling assets for the organization, which will differentiate us in the future. So that's the build part of it, where we want to build new products, technologies, new IPs, incubate startups, and all that good stuff. We'll kind of talk about that as well. So this run, grow, and build. But the key theme I want to leave with all of you is that we should keep in mind that our company, as we kind of build and move forward, we are using our run P&L right now to fund our grow and build. So that's the way we kind of read our results, because it's very important the way that we want to kind of take it forward. And then these lines will merge, and ultimately we want to look at how run plus grow will be profitable, at least in the coming quarters. Can you move on? So quickly, I want to touch upon the high notes in terms of the business updates for you all. In terms of the strategy, if I may look at it, one key accomplishment in Q3 has been that our ability to kind of, we were able to sign a definitive agreement with MDEC Malaysia. This is a very important, critical way forward strategically, because if you know, the last quarter we spoke about our alliance with Oracle, because the Oracle alliance is very critical for us in terms of the entire strategy in terms of ASEAN and Asia. If you look at it from that perspective, Oracle was a very key strategy. We wanted to stay invested as Oracle as an arrowhead. We launched our new 3i Plus Oracle powered services in ASEAN, and we are building a sovereign cloud in Malaysia. And now the third part of it is, now we are tied up with MDEC Malaysia. So this three-way partnership gives a huge advantage for 3i in the ASEAN territory, and this is going to kind of set a new line of business focused on mid-market and SMB in the ASEAN territory. So this is a very, very key progress which I want to report back to all of you. The second is we've been talking about resident engineer program. It's very important that we have to quickly onboard these entrepreneurs, this resident entrepreneur program. I'm sorry, and we have. I'm happy to share that we have onboarded 2 resident entrepreneurs in this program. We give a very unique opportunity to bring in entrepreneurs, and within the frame of a large enterprise, corporate, environment, we want to kind of build next generation technology. So we have cognitive computing services which is kicked off, and we are now starting to build these teams, and the teams are now starting to build the next generation products and platforms under leadership of a resident entrepreneur. Similarly, also in education and edutech as well, we have onboarded a resident entrepreneur who's building this entire end-to-end next generation cloud first, digital first platform, which could be a kind of a path-breaking technology for mid-market universities and a group of schools and educational institutions across the world. So these are the 2 updates which I want to talk about in the resident entrepreneur program. The third thing which we have been also talking about in line with our new 3i, which is incubate, innovate, and invent. We spoke about accelerating the entire in terms of the pace of next generation technologies and the build initiatives. Happy to announce that we have brought in 2 startups on which we are now building our unique propositions. One is in the SD-WAN and SASE technologies, and the second is also in terms of blockchain powered video content lifecycle management in terms of privacy, authenticity, and all the capabilities of blockchain. So this is a very important progress in the strategic direction. These are laying the seeds and foundation for the coming quarters, where we'll be able to build our uniqueness around this strategic interventions. Coming to the business updates, which I think all of you will be eager to listen to in terms of, one is definitely we've been talking about the large deal. We did a press release, and very happy to announce our first large deal in US with Memberos, and this is a large deal for 3i in a very, very long time. We kind of clocked this deal, 5-year contract, $20 million, a potential to grow up to 30 million. It's very unique because it's a convergence of a cloud in a box solution of ours in terms of transforming our customers' entire cloud environment Second also is in terms of ability to bring this convergence in terms of these service lines, and which will also be able to kind of give us a huge change in revenue mix. So that's very important for us in terms of this particular deal in the US. The second also, we will probably announce shortly. We have been kind of shortlisted in a very large deal in Indian PSU, and which is also a kind of a large deal in terms of $60 million revenue, 3-year contract. And then if you look at the other key highlights, if you look at it, I don't want to kind of call out right now, but we are already in February. We have just got 6 more weeks to go for the year end. So it looks good. Maybe first time in 3i history in the last 5 years, I would say probably we will be growing at a minimum of 10 to 11% over our last year's services revenues exit. So which is a positive. Of course, we have to work on our other aspects in terms of your costs and margins. But I think the good part is that the revenue trajectory is now taken off, and with the grow engines, I think this is going to kind of take off in a very, very aggressive way. And secondly, also our focus is not going to be on top line. I was looking at some of the chats with some of the shareholders have also been sharing kind of those distracted, but I'll take it now. For example, our focus is, though we have a very clear $1 billion goal by 2030, our focus would be on margin and EBITDA, because the entire game is changing from a top line growth towards margin enhancement. Any digital company, automation company, which is driving transformation has to only measure bottom line. Bottom line will be the way forward, because technology is going to cannibalize top line. So let's be clear on it. Maybe I'll take those questions. I think somebody was just chatting, so I thought I'll just kind of talk about that. Maybe what I'll do is I'll pause here, and maybe delivery excellence, I would request Harish to kind of talk about it, because he's passionately driving some of these improvements projects, because it's extremely critical for us as we are building for the future, accelerating growth. We also have to keep a clear eye on our costs, and I'll leave it to Harish to kind of expand on the delivery excellence.
Thank you, Thompson. Good evening, everybody. So yes, there have been some messages that has been going about the top lines, the bottom lines for the organization, giving guidances and all. We are cognizant of the fact that we have to improve our top line and also optimize our bottom line. So as Thompson has been giving various inputs about what are the measures we are taking to improve our top line, internally we are taking very serious efforts to ensure that there is cost and waste reduction in the organization. So we are tracking utilization of both billable as well as unbilled resources to the last resource in each and every LOB, each and every geography. So though it's 3 quarters as an organization, new 3iinfotech, we are getting all our acts together, and we are having various initiatives being driven across verticals and horizontals. So few to be listed here quickly is we are trying to ensure that a lot of manual activity which gets done in the organization, especially in the GA, that's the general administration cost, gets done by tools and automated, so that there's lesser manpower required. We have substantial headcount in the GA part of the P&L. So we want to ensure that we have the right number of people doing the right job rather than doing it manually the way it has been traditionally done here. So that's one key area that we're doing. We are implementing a fresh new ERP, Oracle NetSuite. We are getting Salesforce implemented. We are also implementing over 3-4 operational support tools for O2C, P2P, source to hire, so on and so forth. So all these things are being implemented as we speak today, and will go live in Q4 definitely. So that's what we are doing. We're moving most of our servers to clouds, that we are in-prem servers to cloud, so that we can ensure that those costs gets reduced, and this cloud setup that we are doing for the business, it gets utilized for internal consumptions, and we have support costs reduced for that substantially. Margin enhancements programs, we are going project by project, account by account, uh, for each and every geography, for each and every LOB, questioning the viability of this project. So by end of Q4, we will be either having get well plans for projects which are not doing so great in terms of the expected benchmark profitability that we are doing, or like we'll be exiting out of those projects. So that's a very conscious call that we are taking as an organization. In fact, we already started practicing that in a few geographies, details which I don't want to get in right now. So in addition to that, as we grow, we will be needing substantial trained resources, which is like becoming a little bit of a challenge in this great resignation era that we are going through. So proactively, we are building um, competency centers in tier three, tier two, I would say tier two, tier three cities. And across, like we started with picking up a competency center down south in India. And that's the first one as a proof of concept. We are doing it, and it should be live maybe in a month or two's time, wherein we're planning to have at least 100 people uh, team, which will be trained on the upcoming technologies that are hot in the market today, in demand. So we have in-house development capabilities and bench available when we are getting into big projects as we move on. So finally, the big ticket items in terms of the build that we are planning, the next gen technologies, the cognitives, the AI teams also have been recruited, hired, and the Q4 or Q1, we should see revenues also coming in from this technology. So not only investment we are doing there, we are also seeing some revenue trickling in from these units also. So that's generally the approach we are taking towards delivery excellence. There's a lot more to be covered, but I think for this forum, like for this session, we'll limit it to this and hand over to Thompson back on the customers and
Thanks, Harish. Thanks a lot. And I think the key message for all of us is also within delivery and operations is that we want to practice what we preach outside. So most of the technologies which we are incubating, we are now trying it on ourselves, and we are our first customer. And Harish and team are driving it very aggressively across the organization. Thanks, Harish. And with customers, also we got in new logos. And one of the other thing also, because I've been watching some of the chats as well, there are some questions on, reduction on revenue, which has happened. And I know the reason is we have taken a very careful call after 2 quarters, because some of the legacy accounts we want to exit, we have exited. If you look at the customer slide later on, you'll see that there's a drop in number of customers. So customers who are non-profitable, we are ruthlessly exiting very, very clearly. There's a clear refocus on our customer strategy in terms of, named accounts. We want to do business, very clear existing strategic accounts, which we want to grow, and all the standard, customer engagement practices have been put in place. So in terms of even the revenue drop as well, because very clearly we want to exit non-profitable account. That's the very, very clear. And I said the focus will be on margins, margins, and margins. So I just thought I'd just respond to one of the chats I was just seeing, which was just coming. Let's go on, Schneider. Okay. So this is our this is the as reported financial numbers. If you look at it, our revenues is 165 crores for this quarter. And key headlines, which I want to probably highlight here for benefit of everybody, is that we had maybe Sanjay can also help me in this. We had a one-time charge of almost like 9.6 crores. Sanjay, you want to kind of highlight on that particular charge in this particular slide, please? Sanjay? Yeah.
Sorry, Thompson. Yeah, this the 9.6 crore is an exceptional item for this quarter due to the FCCB's early redemption. That's why the charge has come into the P&L. But yeah, due to this charge is what we have. Our PBT is kind of lower, than last quarter, and primarily due to this, and due to the tax expense, which we anyway expect tax to be on a ETR to be on a lower side in Q4.
Yeah, thanks, Sanjay. And also see the other part which I want to kind of share for the benefit of everybody is also if you look at it, the common question in everybody's mind is we kind of down 22.6 this quarter. So one is Sanjay explained about this one-time charge, which is part of the our legacy in terms of our FCCB redemptions. The second thing is also very clearly, if you look at it, we have been funding our grow and build businesses from the current P&L because we need to kind of reorganize ourselves in terms of the organization structure, because the organization structure, we still have our old subsidiaries which are mapped to the run organization. And in fact, I saw some question also in terms of subsidiaries which we have across the world. The good news is that we've got some big fours who are advising us right now to kind of get this new structure. And hopefully this new structure will be in place for us effective the new financial year. So we'll have a very clear run structure and a growth structure and a build structure. So it's very clear. All our investors and shareholders can see this very, very clearly right now because it's all in that one run. So what is happening? All the investments which we are also making for the grow and build are in the same P&L. And see, for example, I'll give you a small example. All the build investments we have made now, which is very critical from the long-term survival and existence of this company, are all part of this P&L. And in fact, we need to kind of capitalize that end of the year because we are building products and value, which we'll probably capitalize. At least if you look at it, almost to the tune of 5.1 crores, we have invested so far in all the next gen technologies we've been talking about right now. So secondly, also the grow investments also, if you look at it, from a grow investments also, there is very clearly around 9 crores or so we have invested in the grow infrastructure, because grow is not just the sales organization or the pre-sales. If you look at it, Harish spoke about COEs we are building today. So we need to kind of build proactive competency centers, train them on Oracle competencies or train them on Microsoft competencies or whatever, so that we have billable resources available. It could be deployed in managed services projects. It could be on transformation projects. So these are all investments we have to kind of invest up front. So if you look at it broadly, the 22 crores, the way I've explained it, minus the one time, kind of 12 crores is investments very clearly across grow and build. Standalone, if I look at a run, it is a profitable business. It is a profitable business. It runs profitably. But the question now is that, the tightrope walk we need to make in terms of running a profitable business and also investing in grow and build for the future. And the endeavor of the organization is that to ensure that at least by Q4, Q1, we'll be able to at least be run and plus grow positive. So that's what we're working hard. We have to get our costs down. We have to kind of eliminate the waste from the systems. We have to eliminate, any other costs so that we can fund the grow and build in parallel without leveraging our balance sheet. I think that's a very important point. Somebody is also, I saw another question on the balance sheet. That's a positive. If you look at the balance sheet, they're very positive today. If you look at it, we are debt free. We are not leveraged it. We still have, receivables from which we need to get from our deal as well. So at least by Q4 end, we'll have a better view in terms of our cash reserves as well. So that's the positive from our organization perspective. So Harish and Sanjay, you want to add anything on this particular slide?
We good on this now.
Yeah. Sorry. No, I wanted to add one more element that we have seen and been working upon implementing the DSO, which have been in a reducing trend, and which has improved by 10 days. That's been a positive sign. And earlier days we could see, because of the COVID impact we had an impact in the earlier quarters, but now things are improving because of our focus in that area, and a lot of improvements in the way we are planning for our recovery, especially in India and the overseas territories.
Yeah, no, absolutely. And I think that's a very important point as well, Sanjay, because that's really helped the cash flow going for us. The collection rigor is helping the organization even without, incurring new liabilities and limits. So that's a very positive for the organization, and, it will help us. And also if you remember the last quarter, also for the benefit of our investors, we took a proactive hit on slow-moving debts. As an organization, we want to kind of ensure that on a good GRC policies, we kind of took this proactive hit of almost 14 crores last quarter as well, and we are tracking very closely on that, and hopefully we'll be able to kind of reduce that as we exit this year. Let's move on, Snyder. So again, it's a slightly a different cut, very similar, but more from an internal view perspective. Just gives a little more details into the sales cost, in terms of the PDDs, which is the provisions we have made for in terms of slow moving debts. We have the build cost. So this clearly kind of articulates what I've been talking so far in terms of the other costs which we have to incur and balance out. And broadly, if you look at it also in terms of the normalized EBITDA, looks positive because exceptional items are one-time items which we had to take a hit because of the deal and a lot of follow-ups from our last year's post-deal scenarios. So most of this, if you look at it normalized, we look at it, we are still positive. That's the way we look at this. So that's a good news. So if you read this from that perspective, yeah. And I'm not going through most of the points. I think we have covered. So let's move on. So a quick geo mix in terms of the geography mix headlines for everybody, because the next question could be from a geography mix. So we kind of rechristen some of our regions, and we want to kind of use this as a very clear strategy. The India business region, we call it the IBR. I used to call it SAG before. The global business region is our North America, UK, Europe, and Middle East and Africa. And emerging business region is ASEAN. And these three are, as an organization structure, we have P&L leaders, regional geography leaders who lead this. And we have Shashank, who leads the India business region. We have Sax Krishna, who leads our global business region. We have Sudeep and Colin Song. Colin and Sudeep lead the emerging business region. Sudeep also drives our large deal, strategic deal acquisition organization horizontally, globally. So that's kind of the market where we are now, how we are leading the organization from a market perspective. And some quick action plans in terms of which also with proactively we're looking at it, how we want to kind of, optimize cost and increase revenue. One of the initiatives which we are running in Q4 is to see how we could probably optimize spans and layers and try and make a more lighter, swifter organization. Even AAA, which is an application automation analytics organization. We are also looking at how to increase the revenue per employee, which is very, very important metrics, and see how we can probably look at reskilling and right skilling our people, and see how we can probably increase their billing rates. Is a very important aspect. We are looking at it. And also continue with the exiting non-profitable accounts very, very clearly, because we do not want to do any accounts which are lower than our gross margin targets, based on whether it's a country to country model or a offshore delivery model or a digital-led delivery model. So we have now set our new guidelines. Typically in the grow businesses, we want to set very clear guidelines for ourselves. The country-to-country model across the world, which is the typical domestic business, which is whether you do it within US, UK, or India, or any of the geographies, we want to ensure that we don't want to do any business less than 18% GM, very clearly. And when we have a digital mix, a humanoid mix, and near shore, offshore, we do not want to do any business less than 30 to 35% gross margin. So this will be a huge change from where we are. If you look at our run businesses, where we are now, around 15% GM, we want to ensure that, we do not want to do any of these businesses less than even 18% GM. So very clear direction, and we will exit any of these businesses which are non-profitable. So that's a very, very clear strategy as a company. And broadly, I think, I kind of covered everything. If you look at the emerging business, I touched upon that the entire New Ray 3i Plus services which we launch in KL will be an important boost to our SMB strategy also, because as in parallel to our enterprise and mid-market, we also want to launch our SMB strategy. We'll talk about more of it in our Q4 once we launch it. But SMB will be a key strategy for us, where we want to offer pre-configured, business process as a service, a software as a service, any of the things as a service powered by a Nure platform. So that's the where we want to kind of head in the kind of the volume business in terms of from our overall SMB segment, if I may put it. Yeah, let's move on now. So quickly on the industry cut, predominantly, businesses have been with BFSI segment. Broadly, if I look at both put together, it's predominantly a huge amount of our business come from BFSI, and more or less our revenue mix has been constant across, because it's predominantly the run business, and the grow is now just stepping up, and we are now starting to get our new businesses in the grow market. So if you look at it from a grow perspective, the focus area very clearly, we want to be super specialized, even BFS, because BFS is a very large area. Within BFS, we want to stay focused on credit unions, because we have existing customers in US, and in credit unions, mortgage and capital markets. So that's an area where we want to stay focused. We want to kind of get deeper into insurance, build some COEs, try and see if we can be an end-to-end orchestrator for the insurance industry, because it's a huge opportunity, because some of the industries have a lot of legacy systems. There's opportunity to offer, an ecosystem around legacy core technology. So we want to kind of build some COEs around them. Definitely manufacturing, retail, and e-commerce becomes very critical in terms of SMBs and startups and well-funded startups. It's an area where we want to focus on. So can we offer these services for them? Agri-tech is a great opportunity for next generation businesses. Even if you look at India also, we are looking at agri-tech business. Indian government has now announced in terms of drone as a service. There's a lot of policies which we can kind of leverage. We want to try and see if we can offer an end-to-end offering, right from a farm to plate, and not just one portion of a process. And telecom, media, and entertainment, we have said this is very important industry vertical which we are building, and senior leaders like Amrita are helping us in this endeavor, as well as we build this kind of industry practice. Yeah, so let's move on. And I'm not going to expand this, I'll leave this. This is again AAA's, our application automation and analytics vertical, which is your core, which is and the IMS, or infrastructure management services, which is your classic infrastructure management services. And then we have your BPS and cloud first. So this is how the mix looks. And the new lines of businesses, we're not just, we will start publishing it as and when now these lines are now starting to sell. The good news is that some of the new line of businesses like Nure Edge, for example, we got our first customers. That's the good news, because most of these technologies which we are proactively building, it is very important that these strategies convert to revenues. The good news is some of the Nure lines of businesses have been starting to get billable customers. That's the good news. In the next quarter, we'll share different lines of businesses across some of these new lines where we are now starting to book revenue. So again, this kind of a client mix, top 5, 14%. The good news about for us is that we don't have huge revenue concentration on few customers. It's a big opportunity for us, because since we came out of a product division, the services division has a huge opportunity to kind of build on it. It's kind of a even spread. The positive is that we can work on most of the existing accounts, and we can farm them, and very clear-cut opportunities to ensure that how we could probably build on the existing accounts. And we are now brought in go-to-market teams which are focused on strategic accounts, named accounts where we want to figure out how we want to expand on it. We have brought in client partner management kind of concepts to kind of farm some of these accounts. So at least we want to kind of move into a mix where at least 1 year from now, we want to look at, we got our first at least in a TCV, but once we start recognizing these revenues, we want to have at least 1 or 2 accounts which will cross 2-3 million, or 5 million this year. and the 1 million plus account list also starts growing because we just added a few more, and this is going to kind of constantly grow. So we kind of have this 5 million bucket, 3 million, and 1 million will be the mix we're kind of focusing on. And the bottom of it, we want to stay focused with the mid market and SMB segments. Yep. Thank you. So quickly, just to maybe talk about the run, grow, build strategy update in terms of services and product strategy, just to ensure that all of us are on the same page in terms of what we're talking. It was very important for all of you all to also understand and support the organization because as we grow together, and so that we'll be able to create a wealth for all of us together. Yeah. And so the run business, we spoke about it. The grow, if you look at it, just to kind of spend a minute in the slide, it's cloud first. Nure is our brand. It's led by Nure 3i Plus brand, which is our Oracle powered cloud. And because this is kind of a beachhead for all of us, so where we're going to have the cloud as a beachhead, and then we add on everything else. Application automation analytics, we have Maggie, which is now we are rebranding our Maggie as automation as a service, Momenta as analytics as a service, Flexib is digital quality assurance as a service, or old school testing. Now we are getting a Flexib version 2, which will be now we are working on, our cognitive teams are working with the Flexib teams to come up with more cognitive self-scripting digital testing as well. So these are some of the kind of shifts we are making, and we are talking about building an Oracle COE, very super focused on Oracle. And it's not just on OCI cloud around, but across even autonomous database in terms of cloud migrations, transformation, because we see a huge opportunity in the Oracle space as well, because a lot of legacy customers who have to be migrated, and we are trying to build this entire COE, and including even Apex, which is the Oracle low code no code platform. Of course, there's a huge focus on digital BPS because the convergence of technology, digital, and business process services, and also one of the mature offerings, and hopefully we'll be able to, the digital BPS team and the BPAS, KPAS teams will be able to kind of bring new customers. We have had some good early success in digital CLM. We never used to be in CLM. We used to be typically a back office shop in back office and BPS. We have got our first customers in digital CLM and customer lifecycle management. And the uniqueness is we want to be a digital first company. We do not want to do anything in classic BPS. Going forward, it will be cloud first, digital first, automation led, humanoid, human together is the mantra which we want to follow very, very clearly in terms of the growth. The build, if you look at it, we spoke a lot about it, but I think I'll spend a few minutes because now we are very super focused, at least for the next year, leadership Amrita and some of our other leaders. We've got this very, very clear. Cognitive computing services, we want to stay focused on mortgage, capital markets, telecom, media, and entertainment. This is going to be cutting edge analytics in terms of prescriptive and next best action. And very shortly, we'll see new products coming out of us, and the teams are now hired, and we will do that. The second thing is also, if you look at the entire 5G services, if you look at that, we are staying focused on SD-WAN and private networks. And in fact, hopefully in Q4, we will be able to kind of announce some of our wins as well, where we are getting there. Edge computing services, we have already had our wins in terms of, edge, new edge services. And the 5G lab as a service and 5G enabler service is something which we're now starting to work. And this is very important for us because this will be a huge opportunity where we could work with telcos, we can sell through and sell to telcos as well. So we want to kind of work with a telco as an ecosystem partner. And this is going to be a great opportunity the way I look at it. IoT and blockchain convergence is something which we want to look at it, and we will talk more about this as we progress. And we want to stay focused in insurance and securities, agriculture and green energy. And fundamentally, the whole theme is that, powered by edge computing services. So this is broadly our refresh our memories on our services and product strategy. Let's move on. And just to bring the numbers back into focus, because this is how the business is also aligned. And hopefully next financial year onwards, we'll be able to report out in this fashion and run, grow, and build. So all our shareholders will be able to see how their company is progressing in these three buckets, because very important in run, we fortify, we retain, we enhance our margins. In grow is where we will focus in driving new revenues, new services, higher margin, and the grow will ultimately replace run over a period of time. So fundamentally, grow is the new services lines which we want to kind of push. Build, as I explained to you, we want to build center of excellences, which is short runway centers where we will have a product or a platform or a solution which we can take into market very quickly. So the build will build the COEs and will give it to grow for them to monetize. So the COEs will be having a 2-3 quarter, maximum 2 quarters of a runway. COIs are something which will have a little longer runway where we might want to work on white spaces, look at some unique ideas, and work with. It could be a huge differentiator, a huge value creator, possibly a unicorn. Is something which we want to kind of stay focused on the build part of it. And the other question is, if you look at some of the other highlights, I'm not going to read through it. These documents are all available. You can go through them in leisure. The key message for us is we have to, the company has to make this balancing act. It's a tough act because from a run, we have to fund the grow and the build. And I need the support and patience of all our shareholders as we turn this company around. And ultimately, run plus grow will be profitable, and build will continue to create huge value for our shareholders. Let's move on. And finally, if you look at it, I want to end with the build COE roadmap for the benefit of everyone. In Q4, and the focus is we want to work with various governments. The philosophy is very simple. We want to work with governments across, not only in India, even within India, with the state governments, and globally also. We signed up with Malaysian government similarly. So we have to stay focused on that because you want to kind of work with respective governments, align our energies with regard to their priorities. And it's a mutual win-win private-public partnerships in terms of skill development, job creation. Ultimately, as a company, we are able to leverage the benefits the governments can pass on to us in terms of subsidies, in terms of, which is ultimately better for our P&L. And in return for the society, we are able to create jobs and skill development as well. So that's a clear focus. That's what we want to stay focused. If you look at a roadmap, Q4, we are now, like what Harish said, we're working on building the COE, focused on Oracle, focused on BFSI and insurance, and one of the hubs we will start in South, and the Q1. By Q1, we will also probably open one in Northeast, and this is very important because what are the two biggest problems today? A company like us, our ability to attract talent at the right cost. It's a huge struggle in metros. Even all the tier 1 players have the same problem. So how do we get quality resources? We invest, train, increase, in terms of loyalty. Second, also at the right cost and our ability to kind of, enhance margins. So the COEs from a tier 3 will be a very important strategy across the world. This is not just India. Similarly, in Malaysia, we have already signed up. We are launching there. In US, UK, we are building this, and we are now talking with Finland also for the build in terms of 5G technologies. And this is the kind of short-term roadmap between Q4 to Q2, and we will update the shareholders in terms of our progress we make on this. This again is a very important strategy for us to kind of maximize our revenues, maximize our margins, and have a steady human capital supply chain which will support us, because that's the core for all of us. So this is a very, very important strategy which we are now working on. So I'll pause here and then I'll take all questions. I think there's a lot of questions in the chat box, I guess.
Thank you, sir. Thank you, Thompson, sir, for your opening remarks. And I must say it was quite elaborate and answered most of the questions. Now we will take the Q&A. We'll move to the Q&A session. I request everyone who has a question to please raise your hand, and accordingly we will unmute you. You can unmute yourself and go ahead and introduce yourself and the firm that you represent and ask a question. Alternatively, after that, if there are any questions from uh, the investors who have logged in from their handsets, they can use the star and 3 button to raise their hand. And once we unmute you, you can use the star and 6 button to unmute yourself and ask a question. So we'll follow a particular queue, a disciplined queue in terms of the questions. If anyone has a question they can also put their questions on the chat box. We'll be more than happy to uh, read the questions and address the same.
I think one Mr. Purushottam wants to speak and he's asking to unmute.
Yeah, one moment. So, sir, before that, I just got a few questions from some analysts. Can we take those questions first? You have WhatsApp.
I'm okay, Schneider. It's your.
Yeah, sure.
Yeah, and there are a lot of questions in the chat box also. I can even answer them. It's okay, but we
Right,
can
right.
take the questions. Yeah.
Sure. So, sir, there is one Miss Riddhi. She's from IDBI Caps. So her question is, what is our investment going to be in the grow and run business? And yeah, so typically this is what she's the IT analyst at IDBI Capital. What is the investment in the grow and run business?
Yeah. See, as I said, I've been considering, even right now, if you look at it, we are already investing, even in our current balance sheet and P&L, we are kind of, investing from our running operations itself. But I think the next financial year, we will have it very, very clearly segregated. And where definitely, if you look at it, next financial year, we are looking at least minimum 2-3 million investment for starters. I'm just saying, if you ask me offhand right now, immediately in the build business, which we will start, because we have an annual operating plan working on the build to at least minimum $3 million dedicated for that. To build it so that we get some immediate results in the next 2 quarters, because we don't have a long runway also. So we need to have some products and platforms, and the build teams are working very closely with the growth teams to figure out and saying that, okay, what is that we can take to market? So that's why we decided on mortgage, capital markets, and some of these areas. So that should be on a short-term investment on the build team. The grow team, if you look at it, if you look at our grow numbers itself, fundamentally, right now, correct me if I'm wrong, Sanjay, we're already almost around 26 crores, right? In terms of the sales investments we are making. Now, even if you break it down, at least 50% of that is going towards our grow business, what we're investing right now. So almost like, correct me if I'm wrong, almost like at least 1.5 to 2 million investment we are making in grow.
Absolutely, you're right, Thompson. You're right.
Yeah, because this is going to be very important, because that's the adrenaline we need to get into the high margin business. Because this entire grow business, the current run organizations will not be able to get the same type of the quality of revenues which we want to get in the future. So these are like 2 parallel tracks the way we look at it. So the grow business is more like an end-to-end organization. It's not just sales. We'll have its own COEs. We'll have its own practice. And kind of the important point is also in the industry orientation of these practices. So we need to invest in all that. So to summarize, I think it is more or less like, we are talking about 3 million in grow and 3 million in build. But grow will be a self-generation organization, because the cash flows and they'll generate cash very quickly, and that's their objective, and they'll have to break even very quickly and generate profits on their own.
Sure, sir. Thank you so much. We will now move on to the questions asked by Mr. Purushottam. I'm going to unmute you. Please unmute yourself and ask a question.
Purushottam, first of all, thanks for giving me this opportunity. I have 2 questions to ask. One is with regard to the revenue movement. If you look at it in IT, we generally see a sequential growth in terms of revenue quarter on quarter, essentially coming from the new book and build that you do, and also taking care of some of the leakage that will happen on account of some of the bad accounts, which every organization will have. I understand in case of 3i, you would have some accounts where you have to drop it because the margins are low, and consciously you have taken a call to move towards a higher margin accounts, higher margin business. But then the new business, what you're getting, and I see considerable amount of new wins coming in last couple of years, should be able to outdo this leakage of revenue, which is not happening is a concern. So rather than seeing a sequential growth, we see a sequential drop. Second, with regard to the employee cost, which is actually, I mean, I was just going through all your competitors in Indian IT. 3iinfotech seems to be the highest in terms of employee cost percentage of revenue. If I look at your FY19 December results, you are somewhere around 55 to 58% employee cost percentage of revenue, which was in line with the industry. But last quarter, you have reported close to around 83% of employee cost to your revenue, which is highest. I mean, I take Happiest Mind, TCS, Infosys, Wipro, Mindtree, whatever, they are all operating below 60%. Why the employee cost should be so high? And in case this is the kind of employee cost 3i has, then how are you going to make profits?
No, great question, Purushottam. I think the first part, I think we need to set basic baselines right. It's a very, very important question you asked me, Purushottam. First of all, this company is just 9 months old. There is no history in this because, see, before March 31st, Purushottam, we were a product-led company. All your statistics are fantastic. We didn't grow for the last 5 years. We were more or less hovering around 1,000 crores or 1,100 crores. And you're spot on, which is 55%, because we had a product division, which had a high margin, and the service division were there. When it was together, if you look at the old results, now post March 31st, first right now, this company is like as good as a new company. Product division is gone off. So our baseline should be effective 1st April, Mr. Purushottam. That's the first point. Okay. Now what we've inherited today, once the product division has gone off, is the services business. Unlike any other company right now, if you look at it, where all of us have worked also, if you have some, right now our problem is we are predominantly country to country business. It is US to US, UK to UK, Middle East to Middle East, India to India is where we are today. That is what we started off this business on 1st April. Our export mix, which is a ODC mix, compared to market, which you spoke about, is the straight opposite. So that is the answer. Fundamentally, 80% is country to country business, 20% is ODC. Any of the peers you spoke about will be the straight opposite. That is the organization we have inherited in 1st April, post the carve-out. So our reference point is only 1st of April. Anything to do with previously has got no reference or no bearing because the company was in CDR, company had its tough times. We had to do that carve-out. We are now settled all our creditors. Now, in fact, somebody was also asking, creditors have been settled. There's another question I saw in the chat box. Now, what is the value for our shareholders or states so far? So if you look at it, it is just 9 months is where we are now trying to turn around this company, which is the run business I keep talking about. And you're spot on. Our current mix of employees will not work. That's why our GM is 15%. Otherwise, market GMs are very high. So the new business in grow, we want to do exactly like our peers. At least we want to be on parity with peers. All the names you spoke about is what we want to be in parity. Even the new accounts we have signed up right now have all got GMs upward of 30-35% after huge competition with the big boys. So that's what we are doing. And second to your question, you had a very interesting question you asked me, Purushottam, because you said, typically we all, you're on your steady state business, what you said is spot on. Now look at us as like a startup. We took it on 1st April. We are sitting and doing all the cleanups. Right now, right from our fundamentals, we are cleaning up our customers. Our new funnel, new engines have now come in. All the order books, revenues will only come in Q1 and Q2. So we don't have any, from last year or whatever, some big orders which we are now ramping up. So what we have got is whatever existing revenue, we are preserving it, fortifying it, trying to see if we can increase our margins, eliminate all the non-profitable customers. The new business which we are getting will get us business only in Q4 and Q1 and Q2. So to your point, theoretically, you're spot on, Mr. Purushottam, you're spot on. Any other mature company which has a 5 years of business which is running, it's no big deal. You'll have a quarter-on-quarter growth. Every IT company is doing that. The way we look at it ourselves is that it's like a startup, because we started out 9 months ago and we're building it. But I agree, from a shareholder perspective, you've been with us, you've been patient with us for the last 10 years. Of course, you might be getting impatient, but we have to now relook at it, reset, and then, together we have to create value. So that's my response to you.
Thank you, sir. We have a follow-up question. So what are the various clients we can expect, and the margins and investment in the cloud-first business going forward?
Now, in fact, I said, the latest win which we had in US itself, which we had a media release as well, is a template by itself. Now, I'll just spend a few minutes on the type of the deal which we are now done, right? If you look at the deal, it has maybe 2-3 tracks. One is we are replacing the cloud service provider, which is a typically 12% margin business. It's a kind of a run rate business. We are replacing a managed services provider, which is around 35% to 40% GM business. And then we are also being a transformation partner. So kind of a blended margin of around 35%, 40% GM is where it is. So this business can be replicated. The second unique thing is what we're telling our customer is, you don't worry about your customers. So fundamentally, it is like a B2B2B. Now, all your existing customers of our customer, we migrate, we manage, and it's predictable business. And it is per customer, one-stop shop solution for them also. It's predictable in terms of their planning. That's the step number one. The second thing is, all scale, they don't have to worry about it. When there is a 2x scale, we have got this box. We have got this pre-configured solution by which we can help them scale. So there's a very unique commercial model as well, which we are now trying to, innovate. So this particular deal itself will help us kind of replicate this across the world. In fact, we are now bringing in very focused cloud-first led sales teams across the world to just take this success story across. It's a massive opportunity. Same if you look at even Oracle COE, why we are betting on Oracle, because Oracle has got huge amount of legacy customers. If you look at what Larry Ellison spoke, out of the 25,000 customers, the people who are yet to be migrated is almost close to 18,000 globally. Look at the size. Now, somebody like us now, we are exactly betting on that. So for us as a small company, it's a wise bet to just bet on that. Even you get a small percentage of that as a preferred partner, I think it's a huge business for us.
Thank you, sir. Again, Riddhi from IDBI, her question is, give me one moment. We'll just get back to her. In the meantime, we will just take the next person. Mr. Shaju Perinchari, I'm unmuting you. Please unmute yourself and ask your question.
Hi, good afternoon to you all.
Hi, good afternoon, Mr. Shaji.
It's a pleasure to join you, but with unpleasant seeing the results. We all thought everything what you've been doing will start earning some results and positivity will come through, but that's not happening. I want to express my concern. Specifically, there is changes in senior management quite often. That needs to be looked at. You need to bring people who are capable and who can lead. That is very important. Secondly, this 9 crores of expenses for the redemption of those instruments. I'm wondering why it wasn't factored in the last quarter or from the very beginning itself. At least, this is something which is not really understandable. Third, is there any more special expenses or something exceptional going to hit us like these last quarters happened. Now, the last one, you talk about grow, build, run, and all. Is it next quarter going to be profitable?
Mr. Panchari, could you mention which firm do you represent?
I work for KSK Capital, but it's an investment company from Emirates, but I'm just speaking on my personal capacity. I'm a significant investor in the company.
Yeah. So, Mr. Sajay, I'll take your questions. I'll take them one by one. The first question is in terms of leadership change. I'm not sure because including myself, when we took over, we have been building a strong leadership today. In front of, we've been able to attract some real top talent to join us. And if you can see our website now, we have brought that. And recently also, we've been able to attract some top talent in our board as well to kind of give us the guidance and, strategic direction. So that I don't think you will have a concern there because we'll have a very, very stable, committed leadership. And all of us are bound by one thing because see, for us now the accountability is very, very high because this is a professional entrepreneurship for all of us, personally, because the lack of a clear promoter, the accountability on the management team is very, very high. So people who come and join us are all bound by the same, a DNA or the theme, Mr. Shadi, which I can assure you that, and that's really going to make a change. That is point number one. The second point which you spoke about is, when will we start seeing the fruits of this run, grow, and build? So I think in all fairness, which I would want to probably spend a minute. Now, the carve out happened, the deal happened, and I think, it was one of the very, how do I say, the shortest time in which we have probably done a carve out deal. Maybe, I do not know, somebody has to check up the M&A space and tell us. So post that, it's like, the new team had to take up the plane when the old team is now bailed out. It's as simple as that. And, we have to keep flying the plane across the Atlantic Ocean. That's what we are doing right now. So the first two quarters was spent on, to your point, to ensure that we set the right baseline, the right foundation to ensure we don't have any surprises. So one is, if you look at all that what we have done, whether proactively booking, slow moving debts, whatever it is, whichever is not done before. I'm not going to go back to the past. I'm just saying from this team has taken over, we've been kind of cleaning it up to ensure that we don't get surprises. To your point, we don't have any more surprises. So if you look at the surprises the costs are either related to the deal related cost, which we are maybe paying this year. Second, which is, typically we should have probably provisioned, maybe we are not provisioned, for whatever reason we are doing it now. So it's like a one-time cleanup which we are doing right now. To your point, I don't think I have my other senior colleagues in this call also. We will not have any more exceptional surprises. But please understand, this company has a 25-year-old history. So I could say that, we will not have any more, surprises which is going to kind of, rock us, at least in the near term, which is for sure. From a current business perspective, if I look at it, you spoke about when are we going to see the results of this grow and build. So if you look at what run business which we inherited, that was not aligned to 2022 and further. Let's be very clear about it. I'm not mincing words, because 3i was a product company. 3i generated profits only using its products. It also did services. Now, once product is sold off, now we'll have to figure out how to be profitable as a standalone services organization, and also in parallel try and see if we can invest in products and other stuff. So it's a very, very interesting journey which we are having right now in this transformation phase. So all the seeds which you are sowing, which will start giving us results in the coming quarters, in Q4, Q1, and Q2, we will have, because we are now slowly building the pipeline and also the new deals, which will start recognizing. Even if you look at our deal which we closed in US, our main revenues will start coming in Q1 and Q2. So all these upsides will start coming, and which will start changing our numbers positively, Mr. Shaji. That is the third question. And you had one more question. I missed it. Did I answer all your questions? Leakage, surprises. Did I answer it? I think I've answered all your questions.
One more point was there, Thompson, on whether we could have taken the 9.6 crore in the earlier quarters.
Yeah.
That is measured, based on actual, arising of that liability. If you read the Ind AS 109, so we have taken the accounting standard, the respective accounting standard, and accordingly, provided, because this is an early redemption of the debt, and considering the future cash flows, it was accounting as of that date. So all of the liabilities we had anyway taken provisions as of September.
Yeah, absolutely. Yeah. Thanks, Sanjay, for that. Hopefully, I've answered Shaji's questions, I guess.
Thank you, sir. We'll go to the next participant. Mr. Siddharth Gupta, please mention the name of the company you represent and mute yourself and ask your question.
And I'm also speaking in an individual capacity as an investor. Along with a few questions, I have some comments for the management as well. And I apologize, I missed the first few minutes of the presentation if they've been answered. It goes without saying that even though you need shareholder support, and even though shareholders are willing to extend it, shareholders are currently quite unhappy with how the share is performing on the markets. So largely the first question is with regard to the ESOS policy, because we've been seeing a lot of them being vested and in being traded on the market. So and that's seen a dilution of about 3 to 4% in the company's equity. So can we have some more details as to at what rate are being vested? Is there a vesting period? How much more dilution is expected in the near future, or that has been accounted for? The next thing that I wanted to ask you was about the exceptional loss. You didn't mention why it has happened, but it's been happening for the 3 quarters where we've been seeing exceptional items popping up. You have mentioned that you don't expect any more negative surprises, but is there anything at all in the future that you'd want us to account for? Thirdly, this is more of a comment rather than a question, is why aren't the deals that are being won by the company, the Bamboo Rose one and the one with Malaysia, being publicized by the company? We're not seeing a very aggressive thing in terms of creating shareholder information and knowledge. There are no press releases being filed with the exchange, nothing of that sort, no deal value being announced. I think today was the first time as a shareholder I've heard that the deal with Bamboo Rose was for $20 million over a 5-year period, which might be a $30 million deal. But just posting about it on your social media won't really help. Secondly, what kind of revenue inflow can we expect from the Malaysia deal in the future? And in general, are there any plans for any QIPs or bringing in any strategic investors that the management is aware of? Because right now what I'm feeling is that although the management's taking a lot of steps, there isn't accurate shareholder value being created. I mean, the share is down 40% from its highs, that too, despite it being an undervalued share. So as much as a patient shareholder wants to support the company, it is a massive test of patience that's being undertaken.
No, thanks, Siddharth, for your valuable inputs and comments. I'll try and answer. I think there's a question on ESOPs. I'll try and answer that. Or Harish, you wanted to answer that, or you were raising your hand?
Yeah, I thought I'll just give a background about the ESOPs
Yeah.
thing. So that there have been a lot of questions in this forum, as well as mails that we have received erstwhile. So I think the concerns are being raised by the number of stock shares that's getting allocated to employees right now. And it's being published by the stock exchanges. So just wanted to give them a brief about how the entire process works, and so that all of us are on the same page. Quite a few of them who are aware of the stock option schemes within the organizations will be aware of it, but for the benefit of the large audience. So the shares which are getting allocated now are ideally shares which have been granted to the employees under 2013 and 2018 scheme. So these grants, the process that an ESOS goes through is first there is a grant of option, then there is a vesting of option, and then there is an allocation of shares. So the grant of these shares have been done way back in 2013, 2018, 19. And each allocation, each grant will be split into three parts, 33% over 3 years. So that's how it gets allocated to like granted to vested to each of the employees. And after 1 year, when the grant converts into a vest, that is when he can exercise it. And when he exercises it, it gets allocated. So we are, as an organization, not allocating any stock options to employees now. All that you're seeing now being published by the stock exchanges are allocations which have happened granted historically. So that's one clarification which we wanted to put on record here, so that like all of us are aware that it is not an allocation of stock options being done at the current moment. It has been done historically. So that's what I wanted to clarify, Thompson, given like having a brief about the knowing the brief about the history.
Thanks, Harish. So to that point, I think Harish has clarified the ESOPs one. But definitely on the ESOPs point, Siddharth, we will be coming back to the shareholders because see, to attract talent and to get best people to work for us, unless people like as shareholders, employees also, now everybody's worried about wealth creation. So nobody's going to work for a fixed. So we will have to come back with more, competitive schemes, and we will come back to you guys on that because that's very, very important for us to attract talent. And but for this current one, which I think Harish has answered it, and predominantly if you look at it, 80% of people who have exercised are employees who have moved out to Essential, correct?
Yep, right, Thompson.
More or less 80% are employees, are old colleagues who have moved out to Essential, or people who have exercised it. That is one. So that to your question, you also had another question, because it was a kind of a mix of comments versus questions. One is what type of revenue which we could get in some of the large deals we spoke about. At least assured revenue, we can look at it at least around $2 million. I'm being very conservative because those are the numbers which we are focused, kind of allocating, AOP. But like any other large engagements, it's up to us to accelerate the conversion of revenues for us, because it's for us to kind of move all the customers to our clouds and kind of get the revenue. So we will try and see how to accelerate. But I think more or less we can look at between both the strategic initiatives, we kind of get almost like $2 million for next year. And also that's an upside of at least GMs of 30% is what we look at the revenue mix change in this new line of business. You spoke about a point taken. I think we did our best in terms of media releases and stuff on this. I think we should improve it in terms of communicating more and more in this more digital world. We will take that feedback, Siddharth, on the point you mentioned. And you also asked a question in terms of strategic investors and stuff. And I'm definitely as a team, we will be working on it to try and see how we can attract more strategic investors into the organization to help us, fulfill the dream of this and the vision of this company. Definitely, we will be looking at it and be working with our board as well to see how we can do that for sure. Yeah.
Thank you, sir. We have a follow-up question from Riddhi again. What is the time cycle for this model from build to grow to run? How long would it take for a company, for a client to
it's an excellent question. Excellent question. In build, as I said, there are two tracks. One is the COE and the COI. The COE, we are now talking about not more than 2 quarters. So in 2 quarters, the build team should be able to create a commercial grade prototype product/platform, or which is ready for go-to-market. So from a build cycle, it will be 2 quarters for us to start recognizing revenue by the grow organization. And typically the grow cycle is any line of business depending on how we'll mature. And the grow, as I said, will be an independent P&L organization. Depends on the complexity of the business, we will stabilize it. So anything between 12 to 18 months will be the grow to run cycle, where it will stabilize and then it becomes like an ongoing run. Is typically the stuff. And more complex build project, which we spoke about, could take around 3 to 4 quarters. is what we want to kind of limit. But all build projects will be from 3 to 12 months at the max, which is, we want to keep it very agile, fast, and fail fast kind of a strategy is what we want to look at.
Thank you so much, sir. We'll go to the next question from Mr. Manas Singh. Please unmute yourself. Please mention the company you represent and go ahead with your question. Yes, Mr. Manas Singh, you have been unmuted.
Yeah.
Mr. Singh?
Hello. Yeah, hello.
Yeah, you're audible. Please go ahead.
Yeah. So I'm calling from Phoenix Consulting. What is your ROE on your current investment, which we are doing quarter on quarter?
On the current investments?
Yes.
Right now, I don't think, maybe you want to take this question, Sanjay, because I don't have a off-the-cuff number straight away.
Yeah, I mean, we would get back to you on that. We will get back to you on the return on equity that we have right now. But it would be, kind of negative anyway, because our PAT is very
Sanjay, his question is, I think if I clarify Mr. Singh's question, he's talking about the new investments we are making. I think that's his question.
Yes.
Yeah.
No, because new investments we have to evaluate. We'll get back to you on that. Yes.
Yeah, because see, Mr. Singh, most of the investments we have made is, as I told you, is only in Q3, because Q1 was more strategy stage. Q2, we started kind of, translating the strategy to action. And the real, investments have gone in Q3, Mr. Singh. So probably we'll answer that question maybe by Q4 and we'll be able to probably put a slide on that, and try and also track and see what these investments are, giving us back. So we will track that. I'll take that input from.
Okay. Thank you.
Yeah.
Thank you, Mr. Singh. We would take the last question from Mr. Vaibhav Bajatya. Please unmute yourself. Also mention the name of the firm you represent and go ahead and ask your question.
Yeah. So I'm Vaibhav Bajatya from Honesty and Integrity Investment. So actually all my questions have been answered. I had the questions around the continuity of the exception and the details of investments that you're doing in other expenses. So I think you have already answered it. That's all I have. So that has been answered. Thank you.
Thank you, Vaibhav. So that would have been the last question. I hand it over to you, sir, Thompson, sir, for your closing remarks.
Okay, hey, thanks, Naida. And I also see, I'm also trying to see the chat box. There are a lot of interesting questions which have come from a lot of attendees. I'm just trying to see if I have answered everything, more or less. I'll be more than happy to answer one last there. So you see the revenue range. I think there's a lot of questions in terms of revenue per employee. I think I tried answering that because that's the current revenue mix which is there, because it's predominantly country to country, and we'll have to kind of change the mix in terms of the offshore, nearshore mix has to change, and the digital mix has to change. I think there are a lot of questions around that in terms of other IT peers, because the other IT peers obviously have the straight opposite of this. And that's why I said our current GM is at that level. And that's the task for the organization also to move forward. There is a lot of questions. Somebody's asking a guidance for Q4. Does the legacy cost is over or left? I think we answered that in terms of saying, yes, of course, most of the legacy costs are done. And we do not want to carry anything into the future. And, we want to have a clean state by which we want to kind of do that. I guess you have presented it all well. One second. I'm just seeing any other questions. Snyder, you want to also see the chat box so that we can answer?
Sure, sir.
Yeah, I see one question on why there's a tax if the company is in a loss. That's because, one of our subsidiaries, our subsidiary in the US, is a profitable subsidiary. And that's the reason, we have a tax which is coming in the books. And we see the tax overall the ETR to be lower going forward, as the the profits getting split across within the subsidiary. So we definitely see that the overall ETR would be kind of lower in Q4.
Yeah. I think you need a fresher program to hire. I think Mr. Singh is talking, I spoke about it. I think we are taking the same strategy in terms of these COEs and tier 3s where we want to build it. Somebody also asked, can we start representing this run, grow and build P&Ls independently? I think, Harish and Sanjay, I think we will start doing it from a reporting perspective also, right? So that it's aligned. I think there are a lot of questions around it. And the same, I think, can you get us some investors?
So I think we can take these questions later on a one-on-one basis.
Yeah, maybe I think I think Snyder, maybe we should formally respond to each one of them because there are a lot of questions. We tried our best to answer most of the questions. I think we should probably respond to them independently as well. Yep.
Yes, sir. Participants, you can feel free to get in touch with AdFactors or 3i directly with your questions. We'll be more than happy to address all your questions. For now, I hand it over to Thompson, sir, for your closing remarks.
Yeah, thanks, Snyder. Thanks, everybody. I think it was extremely, great questions, great comments, great inputs. We are a listening organization. We take all your valuable inputs and feedback, and we will continually try to see how we can, do a better job. And a lot of inputs, a lot of learnings for me also today. And we will try and see how to kind of, quickly turn around the company and start, creating profits for all of us and, creating more value for all of you all. Thank you all for your support and patience and, trust in us. Thanks you all.
Thank you.
Thank you, Thompson, sir.
Thank you.
Thank you, everyone, for attending this call. We look forward towards your attendance next quarter. Thank you and have a great day.
Yeah, thanks a lot.
Thank you.
Thank you.